Good afternoon. Let's take a look at exercise 2-8 and see how we record the transactions in the book of original entry, which is called the General Journal. And this is the General Journal that you see here on my screen. Now, before I proceed to do the journal entries, let's go over a few things over here. Let's start by reading the information presented and see what's being asked of us. So here we have Turpin Company that engages in the following external transactions for the month of November. They've given us 5 transactions. What they've told us to do is to record these transactions. Again, as I said, it's recorded in the book of original entry, which is called the journal, and that's what we have here. Turpin uses the following accounts: cash, supplies, equipment, accounts payable, service revenue, rent expense, and salaries expense. So as we get started, they will give us these account names. In subsequent chapters, they will not give you account names. They assume that you know which accounts to use. Now, for any company, they will have this list of accounts, and this list of accounts is nothing but the chart of accounts. So what I've done over here is, I have my chart of accounts. I have all these account names written down. I'm going to keep them handy for reference. Now, I'm going to bring up this illustration from our textbook. I've taken a screenshot from the textbook. Let me first walk you through this before we start doing our journal entries. Remember, the accounting equation has to always stay in balance. Total assets must equal to total liabilities plus owner's equity. Owner's equity has 2 parts, common stock and retained earnings. And retained earnings is affected by revenues, expenses, and dividends. So let's start first here with assets, and then we'll come from down, we'll work our way up. For all assets, the normal balance is debit. You increase it with a debit and decrease it with a credit. The opposite is going to be true on the other side of the equation. So for liabilities, normal balance is credit. Common stock, normal balance is credit. Same for retained earnings. And same for equity, obviously, over here. Now, let's move down to this bottom section over here. Revenues, expenses, and dividends all affect retained earnings. They're a part of retained earnings. Revenues increase retained earnings. So you increase revenue with a credit, the same which is a normal balance for retained earnings. Expenses are cost of doing business. They're going to decrease your retained earnings. So expenses increase with a debit. So it's the opposite of what you have. Although it's under retained earnings, it's the opposite because it's lowering retained earnings. Every time you incur an expense, it's going to decrease your retained earnings. Same thing with dividends. Do not confuse dividends with expenses. Expenses are payments made to vendors and suppliers and employees. Dividends are payments made to the owners of the company. You're giving them a share of the profit, and that's called dividends. Dividends are paid out of retained earnings. Therefore, dividends increase with a debit. Retained earnings increase with a credit. They're decreasing with a debit. So when I say I have dividends, I'm decreasing retained earnings. So let's look at these transactions over here, and let's see what we have in the journal. To start with, every journal entry must have a date, at least 2 accounts affected, and the total debits must equal to total credits. So let's start with the first one over here. We purchased equipment in exchange for cash. They've given us a date. They said it was all in the month of November. So the 1st of November, we gave cash and we got equipment in exchange. So both of these are assets. Cash and equipment are both assets. One increased, one decreased. Which one increased? Equipment was 0. We now have $23,400 worth of equipment. So I'm going to debit equipment. My cash is also an asset. Cash decreased, so I need to credit cash. So cash credit, and the amounts are $23,400. Again, if you are not quite sure, in this case it was obvious, but if you are not quite sure which account name I should be using, look through the chart of accounts. That's helpful, and that will tell you which account to use. So first transaction, I purchased equipment, which means the company now got the equipment and they gave up cash. In the second transaction, and this the date is November 2nd. We provided services to customers and received cash. We did the work. We delivered. We provided the services to customer and the customer gave us cash. This transaction is complete. It's a cash transaction. So for me, what increased? For me, cash increased. My cash balance went up by 6,800. Where did I get the money from? I got it from customers. Why did they give me money? Because I did the job. When I do the job, provide the service, I have earned revenues. My revenues go up, which means I need to credit it. So revenues will be credited, 6,800. Now I use the word revenue, but here I wrote service revenue because the problem told me to use the word service revenue. Make sure you have that word revenue. Okay, so the third transaction is I pay the current month's rent, 1,300. So on November 3rd, I paid rent. What did I pay? I paid cash. Cash is an asset. Cash has decreased. The company has parted with cash. We have 1,300 less now because we paid. So I can go ahead and do the credit first. I'll write cash credit, 1,300. I know I have to debit something. Well, why did I pay it? Well, I paid it because, well, I used the office space. I got the benefit. Anytime you get the benefit from an outsider, it's an expense. It's a cost of doing business. Go with the most obvious name. Here it's going to be rent expense. Again, make sure you use the word expense. Expenses are debited when we record the expense. My expense went up by 1,300, which means my retained earnings went down by 1,300. In the next transaction, this is now November 4th, I purchased office supplies on account for $1,000. The company got an asset. They purchased supplies, office supplies. Again, I'm using that name because it should have been office supplies because that's the name they gave us in the exercise, and let's be consistent. Office supplies, $1,000. Did I pay cash? Right now, I did not pay cash, and I know it's not a cash transaction because I see the word on account. It means it's a credit transaction. Do I have to pay the supplier the cash? Of course, I have to pay them the cash. I have to honor my word. They gave me the supplies, I have to pay the cash. So I have a payable in my books. A payable is a liability. I promise to pay. So I have an accounts payable. We use the word account payable for all the regular purchases that we make. Any money is owed to vendors. Various vendors will use the word accounts payable. And finally, the last one, we paid the employees salaries of $2,100 for the current month. So the employees have done their work. I received the benefit. So just like over here, I received the benefit of occupying the office space. Here I have received the benefit of the employees working for me. So it's an expense and we call it salaries expense. I paid cash. So I will credit cash and the amount is $2,100. So once again, remember for all journal entries, you must have a date. At least one account has to be debited and at least one account has to be credited. Total debits must be equal to total credits for every single transaction. So with this, we'll get ready to start with the next exercise.